What happens when you have a bad season or a bad game? How do you not get stuck there? We've seen a lot of traders not come back from big losses. We see a lot of athletes not come back from a loss in the Super Bowl. How do you come back from that?
So Raghee Horner, welcome back on the interview on the podcast or the YouTube channel. How are you today?
Great to be here. Thanks for having me back. It's been a minute. It's been a while.
Yeah, I was just thinking this before we went live on the recording, and I interviewed you first in 2017, so January 9, 2017, and I'm sure a lot has happened since then. So can kind of, for people who don't know you now, tell people who you are and a bit of background about yourself first.
Sure. So 2017, that might as well be a lifetime ago with where we are right now in 2020. But what's been going on? What's been going on is, for me personally, we saw the 2018 stock market, the 2019 stock market, and I probably spent most of those years after we spoke focusing on futures indices and different pockets of the sectors in terms of equities. And then, here comes 2019, 2020, and we're seeing just the panic in central banks globally. We're seeing money printing that's probably unprecedented in human history. And so I've been focusing more on commodities and currencies. So, one of the things that I'm hopefully, we can touch on is how important it is for a trader to be able to, understand which asset class is the one that's moving and adapt to that, be flexible, be fluid.
Excellent. So you are usually trading different markets based on what's moving and what you prefer to trade. Is that right? Okay.
My entire career has been very much that. I started with, good old-fashioned commodities, trading things like corn, soybeans, cattle, sugar, and then eventually I got into day trading stocks and sort of they used to call them the SOES bandit, small order execution system, directing order flow, and playing the banks who are keeping very wide spreads, and then day trading indices and starting to trade Forex, and they're all connected. I think that's something that a lot of traders need to be comfortable with, that you can move from one market to the other if you have, I think, a plan rooted in a little bit of macroeconomic understanding and technical analysis.
I'm curious about that. So I personally trade only one market, the Forex market in general. So how often do you kind of evaluate which market you want to be in? Is it like on a daily basis, or is it like more on a weekly, monthly, yearly basis?
Yeah, I'm with you. I've been trading, I love the Forex market. It's the biggest market in the world, and yet in some ways the most unappreciated in some ways. The way that I will assess which market I think is good to focus on is going to be rooted in understanding where commodities and currencies are going, because they're inseparable. Understanding them both gives us a tremendous edge. So I'd say it's really not timing or a calendar date, but rather the behavior of certain macroeconomic indicators. What is going on with the dollar? What is going on with GDP? What is going on with inflation? And that's going to tell me pretty much what the central banks are likely to do. We're Forex traders. We front run the banks because they're pretty obvious in what it is that they're going to do, because they're looking at the data, they're looking at the economy. We know whether or not they're going to be forced to cut rates, hike rates, print money or not. And so I think that that's going to be done just as we notice those shifts in basic, easy pillars of macroeconomics, like the GDP of a country and the inflation of a country.
So basically, you're looking at whether things are going well or not well, and then based on that, the bank will do different things, and then you can trade different market. Okay, I understand that. One of the questions I get a lot from people is, when you trade different markets like this, do you trade the same thing, like the same strategy in different market, or do you adapt to different markets based on the market style or other factors?
Okay, so that's a terrific question. I think it's one that a lot of traders struggle with in the early part of their career, or maybe throughout their career, because shiny object syndrome is a thing, the newest thing. What are we missing? And clearly that's the secret to my success in trading Euro US or whatnot. So the thing that I've done, and I've done throughout my career, is I believe in two beliefs. Things must be universal and robust. That's really system speak, system writers speak for it's got to work well and consistently, and it's got to work on everything. So I'm not going to have a strategy for dollar Canada that is going to be different for Euro US or Euro Yen. Understanding the central banks is going to be the same process. Understanding dollar strength or weakness, same process. So I believe that it's not only important to have the same process. If you don't, you're constantly going to be finding reasons to justify your position, most especially if it's moving against you. And so to your point, it's got to be the same process for me.
what would be advice for newer traders that are looking to either learn or kind of kickstart their career into trading and eventually make it long term? How would you recommend them to kind of start, and what should they go through to be able to learn the right things from the start?
So I think, funny enough, even though a lot of traders feel intimidated perhaps by the Forex markets, I think they're the ones that in many ways are the most new trader or even small account trader friendly because of how granular you can be on the account size, just how small you can trade in terms of what you're risking and how in your position size. So I think that's very much a Forex only kind of perk. I mean, sure, you could trade options and futures and stocks, but the ability to be very small. I mean, risk $100, risk $1,000, or at least only need that much to start a trade is very small account and new trader friendly. So I kind of come back to the Forex markets. Also the flexibility in hours. I come back to the Forex markets, being able to look at the US session, European, Asian. So pick your market and then pick a market that doesn't really dilute you too much. I think new traders starting in stocks, way too many temptations. You've got 500 S&P stocks, you've got 3,000 equities that are pretty active on any day. Way too much dilution in terms of attention. Futures can be difficult because of things like limit moves and futures contracts overnight can be quite cost prohibitive. You want to take a NASDAQ position in the futures overnight, you better have $7,000 to $8,000. A lot of traders right now trading crude oil saw sudden increases in not only volatility but margin. Heck, some of them found out the hard way. Liquidating those contracts can be very difficult. We don't have those problems in Forex. So even though it seems counterintuitive to a lot of folks, trading currencies, I think, allows for a lot of latitude for someone who wants to start. Not too much distraction, a really good focused set of pairs, less than 2 dozen, really less than a dozen that you can look at. Very flexible position sizing, excellent order entry, simplicity, and 24-hour access, which a lot of people forget is really a lot of risk management. And the liquidity, we don't have the issues that folks in crude oil just had. Not that that is dominant in the futures markets, but if you don't know what you're doing in futures, you are going to get run over. And sadly, a lot of folks found that out last week, or when the May contract closed.
And kind of a similar topic. Last time we talked, we discussed about the idea of trading Forex on 5 hours a week. And is that still something that you do, or did that evolve something like different or more advanced?
So that book was, and straight up, that was right around the time that Tim Ferriss released the 4-Hour Work Week. And I thought, what a brilliant concept. I mean, he beat me to it in the title, but that is what I was doing, spending about an hour a day, looking at longer term time frames, putting my trades in and walking away, because it was in my walking away that I found I wasn't overanalyzing, over tampering, over micromanaging my trades. I was actually seeing an inverse relationship to the amount of time I spent and my profits, which is something a lot of traders should consider. More time behind the keyboard and monitors is not necessarily good. So the idea from Forex and 5 was, how much can I automate? Can I automate understanding historical volatility? Can I automate understanding underlying market trends and make it a system, but still execute it from a discretionary standpoint? So make the process very A, B, C, D, very chronological. Either the criteria is met or it's not. But at the end of the day, I still like to be a discretionary trader. And no, I haven't deviated at all from that. That was a book that I wrote in 2012, I think. I don't remember. It's been a while. But no, I haven't deviated from that really in any way. In fact, if anything, I've taken that philosophy and added it to futures, and added it to stock options, and added it to futures options, and added it to ETFs.
Are there some markets where it's harder to do on 5 hours a week, or is it pretty much possible for anything, any market, any instrument?
I think it's an interesting angle. Is it possible? Because I think it really comes back to a philosophy that I think you and I might have spoke about back in 2017, and that is the employee mindset versus sort of the entrepreneurial mindset, or the results economy versus the time economy. And a lot of traders coming into trading are coming from a time economy. They're coming from punching in the clock. They're coming from showing up at the desk at a certain time and putting in the hours and being compensated for the hours that they put in. In trading, the markets could care less. The Euro US could care less, my friend, right? Whether or not we were there since 4 a.m, whether we spent an hour analyzing or a half hour analyzing, it's purely a results economy. It's purely, did you get it right or not? And yes, time is part of that, the analysis, the study, but we live in a results economy. So with that in mind, is that 1 hour realistic? Absolutely, because I'm not getting compensated for spending more time behind the monitor or more time analyzing. It's just very binary. Did I get it right or did I not? So I think after observing myself for 30 plus years now, and then now I'm actually training traders in something I'm doing called a Forex Mastery over at Simpler Trading, where I'm watching new traders realize that they're making the transition from a time-based economy to a results economy. They're thinking, oh, Rag, I'm actually doing better when I spend a little less time on the trading and the analysis. I'm making crisper decisions. I'm not looking at the trades, trying to make something up. If nothing's there, nothing's there, and I just move on to the next chart or even the next day. So that time economy shift to a results economy, I think, is one that's very difficult. And limiting the hours that you're allowed to look at the chart, which I know is so counterintuitive. I need to study more. That's not really true. I find it, the less time you spend actually looking for a trade, the purer the setup really is.
I'm very curious about that last point, because a lot of people are going to say that they want to look at the chart to not miss a trade. And they're afraid that if they go away from the chart, they will miss something, or they miss the news, or they miss a trade or something. So how do you convince those people to not look at the chart all day?
Well, if their superpower is insomnia, then for sure they'll never miss a trade. But I don't know. I'm still needing my 6 to 8 hours, 5 to 6 hours a night. I think in a 24-hour market, quote unquote, missing a trade is something A, we're just going to have to accept, and B, maybe we need to relabel what missing a trade means. So again, for example, what I focus on when I'm trading a new trader, and a lot of these traders are adapting to this. So part of mastering Forex is mastering time. In terms of hours of the day, what time is it? And along with what time is it comes what kind of expectation in terms of movement, what kind of volatility could I anticipate? What is normal for that time of day? And a lot of traders, when they really look at the data, things that I've been looking at for well over a decade now, you'll realize that the prime time hours in Forex, I'm sure you've noticed it too, most of us kind of realize it anecdotally, are between 8 and 11 a.m. Eastern, where the UK and European markets are overlapping with the US Open. Most of your dollar pairs are going to have their most volatile, widest pip ranges from top to bottom during those 3.5 hours. And then it drops off as soon as Europe and the UK, punch out of the office and go for a pint. They're done. They wrap up their day. And so if we follow the activity, the best 3 hours are between 8 and 11:30 Eastern. If we look at the Asian session, again, you're probably looking at a pretty good amount of volatility from, say, 9 p.m. to 11 p.m. again Eastern. And we will see another pickup when Paris, Frankfurt open. We'll see another pickup when UK opens. We'll see another pickup when the Asian session closes at 4 a.m. Eastern. And then, boom, the volatility once again drops. So I think a lot of traders realize there's kind of an ebb and flow, like the tide, in the markets, and not all 24 hours. I mean, here's the punchline. Not all 24 hours are created equal. So we focus on those, I think, about 6 hours, maybe about 3 in the morning and the 3 in the evening that are sort of ideal.
So I'm curious to know your thoughts on this. Would you recommend people to decide on a session they trade based on the availability, like the time they have available in the day, or based on which one they perform the best at, or which one they like the most?
We like the most, we're going to gravitate to, right? So you're right there, my friend. I think in terms of time frames or even the markets, they have to do the analysis study. They have to do the volatility analysis study. They have to focus on markets, preferably that are trending, because Forex markets, as you and I well know, are the best trending markets in the world. When those giant, when the giant tectonic plates of the macroeconomics and the central banks begin to move, they're not things that turn on a dime. They're not things that start suddenly. Typically, once they get moving, like a freight train, they keep moving. So, finding those trends, and then finding those markets that are trading with behavior that is manageable from a pip movement standpoint. In other words, that the Euro US moves high to low ranges in a very different way than dollar Canada, and very different than, say, pound yen. And I think in the early stages of some Forex traders, it's really important to understand those nuances. It's a big part of what I do in the early stages of training any trader. forget the technicals for a moment. What type of historical volatility does that pair undergo? And can you afford to be wrong? When you have a pair that has a lot of volatility, they've been calling the pound yen the twisted sister for most of my career for a reason. Oftentimes it's been very volatile. And just that behavior can make that pair, let's use the word unaffordable. Not that it can't have great technical setup, but the ranges are so much wider. And when we denominate them to dollars, a trader has to ask, can I afford to be wrong in that pair?
Do you have any favorite kind of strategies or set up in the market, or is it something that you kind of build for yourself?
So my favorite strategies for the market, once I've done sort of the things that are sort of unique to what I do, they're proprietary tools, but they're available freely through a lot of Forex brokers. So I'm not talking about having to go buy a bunch of fancy software, not at all. But once you've done the homework, the foundation, the groundwork of understanding the volatility and understanding whether or not a market is trending or not, at that point, it's unbelievably, almost embarrassingly simple what I do. I just wait for pullbacks in uptrends and bounces in downtrends in an amount of a range that mimics what the average to high daily price movement is. So for example, what does that mean? Let's say the Euro US travels 105 pips on the upper end historically. I'll be looking for retracements within the confines of that movement day to day to day. So did it move that number of pips, and did that number of pips move into my technical range for a long or a short? So I combine corrections with historical volatility, and historical volatility has by and large been a tool that hedge funds have kind of used very quietly for a long time. The only reason we're ever reminded that hedge funds use historical volatility is when we see historical volatility suddenly increase and their risk suddenly increase, and then we start to hear how much trouble they're in. And then we remember that a big part of their position sizing and risk awareness is historical volatility ranges. So I thought, well, why not use the tools of the biggest folks in the world when it comes to markets, these hedge funds? And instead of using it for risk, I use it for entries. So once you've got that down, then it's just retracements. Like I said, it's embarrassingly simple.
It's funny because one thing I've noticed for myself over the years is that I get more and more simple, and things that I usually kind of tend to reduce a little bit to being more simple. So you've probably seen the same for you as well.
I think, I don't know if it's just a matter of, when we're first learning so many new tools. I'll use the analogy of golf or fishing. When I first started golfing, oh my gosh, all the different clubs and the different balls, the equipment, and all the accoutrement, right? We really get into that. Fishing, same thing. There's all the stuff, and that's kind of the fun of the early stages of trading. But then, like you said, after a while, once we get that out of our system, and that's very human, that's very logical, then we start to whittle away. And I think we spend the rest of our career like a really good sculptor, having this big hunk of clay that we're just whittling away from until we end up with just this very small set of tools and very small set of beliefs that we say, this is what works for me, this is what I'll stick with. And you're right. I think the longer, to your point, that we trade, the smaller the thing. If we're doing it, let me say this differently. If we're doing it right, I think we whittle away. I think some traders continue to add clay, unfortunately, and they find themselves suffering as traders because they're not doing the natural process of simplifying. To your point.
How was the progression in terms of mindset and trading? Did you have to kind of work on your way of thinking and your belief, or did that kind of came right from the start?
Yeah, as far as mindset and belief, I think the first one is adopting that time versus results economy. Get out of that employee mindset and get into the entrepreneurial mindset. We are paid for our results. It doesn't matter how much time you spend; you get no bonus points for that. And so I actually find that not study and not preparation. I'm talking about time trading. Study and preparation are going to vary, and I think that's invaluable time. But you're going to see an inverse correlation to time trading and your results. And I think the more time you spend actually trading, pushing the button, looking for trades, entering, exiting, you're going to see an inverse correlation in terms of profits. And then as far as mindset goes, I think, look, Charlie Munger talked about this a long time ago, Warren Buffett's right-hand man at Berkshire Hathaway. And he talks about two things. Warren Buffett talks about it too. Whether it be, obviously we have an international audience, whether it be cricket or whether it be baseball, you are the batter at the plate, and you're waiting for a very specific swing. And the best batters in the world know what their pitch is, and they will not swing at anything other than their pitch. Now, a really great batter has a lot of pitches that are within their ability to do something about. So the patience to do nothing is part of it, and that's very much a sort of baseball, cricket, if you will, mindset. And then the other one is the cognitive biases that we're all ruled by. Marketers know our cognitive biases. People who want to, make us do certain things, manipulate our behavior, know the human cognitive biases. And Charlie Munger had a great lecture on the very common cognitive biases that affect traders. That really rules and helped my trading. Avoid those cognitive biases, recency bias, things like that, and catch them early in the cycle so I don't make dumb trades.
I think that one that also helped me on that kind of analogy of baseball is that there's always a probability of getting it, and the best players only get like 3 out of 10 perhaps, and something goes with trading. So I think that's something that I had to work hard on, and I feel like a lot of people do the same thing. They want to be right, and so you can't be right all the time.
Right. They want to hit home runs all the time, every time they're up to bat. Exactly. It's so funny you mention that, because one of the classes I had done last year, I did something called Market Money Map. And internally in my office here, we called it the Moneyball class. So I don't know how many watched the movie with Brad Pitt, Moneyball, or read the Michael Lewis book, Moneyball. And they talk consistently about on-base percentage. Can you get on base? Not can you hit a home run? Can you get on base? And I think you're so right about that. You just get on base. Small wins consistently put you in the Hall of Fame. Small, on base hits put you in the Hall of Fame. You're so right.
Excellent. From your background, I can tell that you probably read a lot of books, and I'm pretty much the same. So are there any books that you would recommend, maybe outside trading, like books that help you become a better trader but are not focused on trading, perhaps?
Oh, I love the question. Yes, everyone asks about trading books, and it's usually the same 4 or 5 names, Reminiscence of a Stock Operator, things like that. So some of my favorite non-trading books, well, going back to baseball hitting, there's a book written by a gentleman who's considered the father of sports psychology, H.A. Dorfman, and he wrote a book called The Mental Keys to Hitting. It's very thin, maybe 60 to 80 pages, and it talks about physiologically, psychologically, what a baseball hitter thinks should behave like when they are at the plate. And I think a trader is very much like a batter at the plate. Another really good book to read for traders, kind of going back to what we were talking about, is Moneyball. Understand that we're not here to hit home runs, that we're looking for on-base percentages. And even though sabermetrics is for baseball, I think the mindset and the application to position sizing, expectation for trades, there's an analogy there. It's not direct, but I think philosophically, Moneyball was a really interesting one as well. And then, another one that's psychological that would be an interesting one is a gentleman named Jim Afremal. Dr. Jim Afremal wrote a book called Athletes Comeback. Athletes Comeback. In other words, when you've had a bad game, when you've had a bad season as an athlete, I think a lot of traders are sports fans as well. We kind of identify with athletes, and that athlete's comeback is very much kind of geared towards what happens when you have a bad season or a bad game. How do you not get stuck there? We've seen a lot of traders not come back from big losses. We see a lot of athletes not come back from a loss in the Super Bowl. How do you come back from that? So those are 3 that I would highly recommend.
Yeah, those are really interesting, and I never heard of them before, so I'll definitely have to look at them for sure. And we'll try to leave links below, of course, in the description and the podcast show note, as well as your books, of course.
Oh, don't worry about my books. I mean, if traders want to learn more about what I do, they'll find me on Twitter. They can find me over at Simpler Trading. That's my newest stuff. You don't have to worry. Read those other books, though, for sure.
What I think is good from you is that you have a very, I would say, like entrepreneurial kind of state of mind and like way of doing things. And I think that's good for trading, but that's good also outside of trading, of course. Do you think that this is something that you develop over time, or did you have that like a long time ago when you began trading?
That's a question that takes us back to, say, the turtle traders, right? The bet that William Eckhart and Richard Dennis had, can you make a trader? One said, no, they're born, and the other said, no, I think I can make them. I think you need a little bit soul of a gambler, a little bit. I think people use the word gambling as such a bad thing. A good gambler, a great gambler. I've actually taught a professional gambler how to trade many, many years ago. He was an honest to goodness, written up in Forbes magazine gambler, and he had rules. He had risk management. He even had a specific diet. He knew what time of day for him were the best hours to be at the casino. So I think you need a little bit of that because we are risk takers. Trading is not, I know the word risk management comes up all the time. I think that's actually wrong. We are risk takers and we have to accept what risk we're going to take. So if you don't have that risk taking spirit, a little bit of that, it's difficult. I think entrepreneurs naturally have that. We also probably cherish freedom over darn near anything. I think traders rank, the ones that I speak with, rank freedom amongst almost everything. They want the freedom to work when they want to. I think they're also very intellectually curious. Not that people who work for a company and employees are not, but I think traders are very intellectually curious. I mean, I'm not the only trader with a massive bookshelf in their office. So I think if you have those things very naturally, you can take risk. You have a little bit soul of the gambler. You're intellectually curious and you understand your risk taking is really a big part of what you do. Can you have some of those naturally? Of course, but can you develop them? Because your desire for freedom, financial freedom and time freedom are so strong that you're willing to develop those muscles? For sure. I think it's both. Some traders just have a leg up because they're just better wired for those things just from the womb.
I think for me, it's been part of, like, yes, a little bit at the beginning, kind of like you said, but also I think the people you meet over time and the people you come across kind of help you develop that aspect as well. So let's say you could meet traders, they help you develop that part of you. You meet an entrepreneur, they help you kind of work on that more. Have you met any kind of big mentors in the past that really help you become who you are today?
Mentors, you make a good point. People can change who we are. The right people can change who we are for the better. And yes, we're blessed to have those people in life. Most of my mentors now are people who help me out from the standpoint of, okay, Rob, don't get too caught up in your last great trade, or don't get too caught up in, building a particular indicator. So they're more like a loving but gentle correction. They're making sure I'm mentally not kind of disappearing into my own head. But early on in my career, I had a couple of different mentors. I had one technical mentor who introduced me to the work of folks like Charles Dow and Richard Schaubacher. And I had another mentor who worked on the global investment desk of a major bank, who taught me the right way to understand macroeconomics, not get caught up in headlines, but have a process for understanding macroeconomics, which helped me unbelievably as a Forex trader. And then after that, a lot of it was time spent in my office and just looking at, kind of going back to sports. I love football. We're not going to have a football season, it looks like, this year. But like a good quarterback spends a lot of time looking at film of the opposing team. Well, I don't have an opposing team, but I do have a lot of charts I can look at. And a lot of it was just observation. And I'm with you too. You look at chart after chart after chart at some point where those synapses are firing, those patterns are, becoming more and more prevalent and obvious. And I think some of that is just in the hours, like a good quarterback just watching film. So not a lot of mentors, but just enough to keep me on the right track.
I think you need both. You need a lot of time alone and a lot of time with other people too that push you to work harder. So totally.
Very well said. I agree. Yes.
And who is it that you look for, that you look up to these days?
I really, myself in like 5 years, I want to know who I'm going to be in 5 years. The books I'm reading now, the trades I'm making now, the processes, the journaling that I'm doing now, me in 5 years, how much better can I be? So the dangerous thing about too many mentors is that you'll have too many ideas. It's like too many books, too many trading strategies, too many classes. Luckily, at a young age, I had mentors that taught me how to, my first broker was a mentor. I have had a full service brokerage account. I paid $150 round turn for my commodities trades. I've got a broker friend now who understands the ins and outs of the Forex market. I spent about 4 or 5 years as the chief currency analyst for a brokerage named Interbank FX, who was bought out by another company sometime later. But I got to see, I had mentors there that explained to me, this is how these orders get filled, and this is how they get pooled, and the time, So luckily I had those at certain times, but luckily they were early in my career or earlier. So now it's just, what am I doing now that's going to make me better in 5 years? I'm looking forward to that. So I'm kind of my own, not to be so self-consumed, but I think at some point, as you said, the time alone is really important.
I feel like, at least for me, one thing I've seen is that people begin as mentors and then they later turn into connections. So they're not like necessarily mentors. You don't like learn from them every day, but they became like someone you can reach out to if you need help or things like that. So
I think if you journal a lot, if behind me it's up on the top shelf, but if you journal a lot, you can go back and look at how you handled certain problems. Like for example, right now, what we're seeing with the central banks, what we're seeing, I've got journals that I can go back to from 1998 and how did I trade currencies during the implosion of the long-term capital management hedge fund and the Asian contagion and the implosion within Russia. I can go back to those journals from 98. I can go back to my journals even from Gulf War One. How was I trading crude and gold? I can go back to journals from 2008 and look at. So I think sometimes if we journal honestly about what we're seeing and observing, we can go back and again reference how did we get out of that problem back then? What were we processing? What were our challenges and how can that help us now? Because history does repeat itself again and again. So I'll refer back to the old me and how did I manage it back then?
interesting you said that because I remember you said this in the first interview, and I actually began like keeping a log of journals, and I have this back shelf of my library with journals, which is quite funny. So just remember me of that. It's awesome. How do you journal? Is it like I guess on like physical journals, and do you have like a process to do it, or just like free flow writings of things you come across?
Okay, so it's not Dear Diary, today I hate the market, the euro was so mean to me. But kind of, a lot of screenshots. So I'll use software like Snagit or Jing. It doesn't matter. There's a lot of free software out there. I'll take a lot of screenshots before, during, after. I still keep those. I have folders and folders and folders on my desktop that have the date and the screenshots I took of the market as I saw it. Because a picture's worth 1,000 words, or a chart's worth 10,000 words. So I can write as much as I want, but my annotated charts, what I was seeing live at that moment, before, during, and after a trade are invaluable. I still do that very much. I just don't print them out like I used to. That's a big part of journaling. I think people are typically associating journaling with a lot of writing, and I find that to be cumbersome. We don't always have that kind of time, but we can annotate a chart and take a snapshot of it instantly. So I'll do a lot of that. And then after the day is over, I'll try to do a good amount of journaling, at least set aside 15 to 30 minutes to talk about what the markets did, what I did right, what I did wrong, what I missed, did I skip my process? And that's just to mentally keep me within my process, my time tested process. But a lot of the journaling for the actual trades, a lot of people say, well, write out your risk reward and write out this and write. You know why we don't journal? It's too cumbersome to do all that. So now I just do a lot of screenshots. I think it's much more, realistic to journal in that way.
Yeah, I'm a big fan of that too. So I'll try first the idea of like having an Excel log with like all your trades, but I just leave it up after like a week or two. It just didn't work for me. It didn't click.
Yeah.
Then have this for like keeping track of my screenshot and putting them into an organized format, and that just works out really well. So
there are a lot of, to your point about just giving up on the Excel files, they're miserable. I didn't become a trader to be, living in a spreadsheet. But there are a lot of neat pieces of software. And again, I don't support them. I don't have any financial interest in them. But I use things like Trade Metria, and I'll just upload my trades into Trade Metria, and then it just slices and dices what I did, how long I was in the trade, and you start to see certain patterns emerge. And that way you could, you have to plug things in manually, just import your daily or weekly, however often you trade, your account records from your brokerage into a third-party piece of software. Trade Metria is one that I've been using for futures and Forex for a while. There's another one called EdgeWonk, I think. I'm not familiar with them, but I'm just trying to think of some other ones out there. And I think I have one I use for options called Wingman Tracker. So I use a lot of these third-party softwares because, to your point, who wants to spend time doing Excel spreadsheets? But we know there's valuable data there. So that's what I do. And that, I guess, that could be part of the journaling. You're right. That's a really good point.
yeah, the data is super important, but you don't have to enter it in yourself, especially in 2020. So I agree with that. Awesome. Are there any topics you didn't cover that you'd like to talk about or mention?
Sure. I think one thing kind of right now that I think a lot of traders should be looking pretty strongly at, and it's not often that I get to talk to traders who are, dedicated Forex traders, even though you might be trading other things. Long dollar to me is a really important position right now. Long dollar, long gold. Gold is a currency. It may be a precious metal, but it behaves like a currency. I think that it's also important to keep an eye on what bonds are doing. I think bonds are going to continue to move higher. So most of my approach right now is very much rooted in those positions. And when we talk again in 6 months or a year, it'll be interesting to see where those are. So long dollar. I'm still very, very bearish the com dolls. I still think that not just what's going on with China and the current environment with the pandemic, but looking at shorting things like the Canadian dollar, the Australian dollar, the New Zealand dollar, even the British pound to a certain degree they're important positions in my book right now, in my book of trades. And those are the kind of things that I'm doing in the Forex Mastery that I'm doing right now with Simpler Trading, where every month we sit down like a think tank and look at where all these macro pieces are going. So I'm kind of giving hopefully the listeners a little glimpse into what we do every month. And a big part of what I'm doing right now is looking at those opportunities to short, get into building shorts in Australian dollar, Canadian dollar, and New Zealand dollar, specifically against US dollar and Japanese yen.
I think this might be a good opportunity to explain, because a lot of people might not understand that really well. So why is it that the dollar is going up when the US economy isn't going so well? So I naturally would expect that people would want to buy other things or would want to invest more in gold and different market, as opposed to the US dollar, which is not going too well.
Yeah, it's a great question, because it was something that we did in the chat room just last week. Someone said, Raghee, we're printing dollars. The Federal Reserve swap window keeps opening. The dollars are flooded all over the globe. And then it's something that I think all traders know, but may not understand the mechanics of the importance of what it means to be a reserve currency. It reserves the right for us to run up ridiculous amounts of debt, which is true, but it also means that all commerce, global commerce, India is buying, say, crude oil from Saudi Arabia. They're doing it in dollars. South Korea wants to buy, whatever from whomever. I just pick two countries. The transaction is going to happen in U.S. dollars. If one country is lending dollars to another, not the U.S. lending to other countries, but lending to each other, debt is also globally denominated in dollars. So the demand for dollars will continue to rally. For those of you that are macroeconomically, interested or astute, that the debt cycles that are happening, we're at maximum debt cycles. We have different debts globally, corporate debt that needs to be paid back. They need to be paid back in dollars. So countries need dollars. Right now, we don't have enough dollars as much as we are printing. As the debt increases, that demand for dollars too increases. So it's not the demand for euro, it's not demand for yen, it's demand for dollars because of that single fact. So unless a trader believes we're going to see mass sort of country defaults, right? Countries not paying each other back, there's no reason to think that we're not going to continue to see demand for dollars. And I'm not going to say from a safe haven standpoint. I'm being, I think, a much more practical, saying, look, as long as the reserve currency status is with the US dollar, as long as certain currencies are within the IMF reserve basket, those are the currencies to keep an eye on. And other countries have to have dollar reserves to, again, global commerce and servicing, paying back debt.
Interesting. So where can people find you if they want to connect with you or reach out after this interview?
Oh, sure. So, I'm on all the different social medias. You can find me on Twitter. I'm a little salty on Twitter, so that may not be for everybody. I do a weekly Facebook show called Forex Fridays over at Simpler Trading. That's a free show. You can just watch it on Facebook every Friday at 11:30. And then I've also recently begun, and it's brand new, so it's still in the stages of, building the education for traders. The timing is really good. I'm doing a Forex Mastery where you can follow along with my trades and meet me once a month with the other members online, a big think tank about what's going on in the Forex market specifically. And that's over at simplertrading.com/FX. You can check that out there. So that's where I've been spending my time. My desk is sitting, just outside of the camera range, but this is where I've been. One of the beautiful things about quarantine is it doesn't feel that different for traders, not to make light of what's going on, but this is such an ideal time to just hunker down and learn a new skill that is going to serve you for the rest of your life.
Thank you very much, Raghee. I appreciate it. So we'll put links below for all that in the description below the video or in the show notes for the podcast. I hope people check out your stuff because it's definitely really good, and as well as your books and what you're doing with the Forex Mastery. That's awesome. And I'll talk to you pretty soon, I guess.
Thank you, my friend. It was great to catch up with you. I hope you're doing well, and I hope all your listeners are doing as well by taking care of each other.